Hello and welcome. Let's talk about one of the most debated areas in salary taxation, right? I'm talking about those big payments that can happen just before a job starts or right after it ends. The new Income Tax Act of 2025 finally gives us some real clarity with Section 18, which covers what's called profits in lieu of salary. So let's break down what this actually means for you and for your clients.
You've all been here, right? A client gets a pretty hefty payout when they're changing jobs, and the million-dollar question, or maybe the 5 lakh rupee question, is this. Is it a tax-free capital receipt, or is it just part of their salary? Getting this wrong can lead to some really serious disputes. And that ambiguity, that is exactly what Section 18 is designed to get rid of once and for all.
All right, so here's our game plan for today. We'll start by looking at the problem, then we'll introduce Section 18 as the solution. We're going to break down its 2 key clauses, walk through a really practical case study, and then we'll wrap up with some key compliance tips and common pitfalls to watch out for. So let's get started.
So, first things first, what's the core issue we're really tackling here? Well, it's all about those payments that seem to live in this kind of gray area, just outside the regular monthly paycheck.
Just think about it for a second. We're talking joining bonuses, severance packages, payments for non-compete clauses. For years, the big argument has always been whether these are capital receipts, which could be tax-free, or if they're revenue that's tied to employment. And let me tell you, this is not just some academic debate. It has huge financial implications and can very easily lead to some nasty tax dispute.
And this, of course, brings us to the government's answer to this whole problem. Section 18 of the Income Tax Act 2025. This is the provision that's meant to bring all that clarity we've been looking for.
Now, to really understand Section 18, we have to take one step back and look at Section 16, which is what defines salary. Clause F here is incredibly broad. It says that salary includes profits in lieu of or in addition to regular pay. Section 18 is what gives that broad phrase its specific legal teeth.
The intent behind the law here is crystal clear. It's all about plugging a loophole. If a payment's origin, its very DNA, is the employment relationship, doesn't matter if it's starting, ongoing, or ending, the law now says it must be taxed as salary. This stops it from being cleverly disguised as some kind of non-taxable capital receipt.
Now, for those of us who are familiar with the old 1961 Act, this slide really highlights a major structural change. This whole concept used to be kind of buried deep inside Section 17. By pulling it out and giving it its own standalone Section 18 in the 2025 Act, the lawmakers are sending a very clear message. Hey, this is an important area of tax law and we're making it absolutely impossible for you to miss.
So, how does it all work? Well, Section 18 is pretty neatly divided into 2 main clauses. Each one targets a different set of circumstances. Let's break them down.
First up is Clause A. This part is all about payments an employee gets from a current or even a former employer when their employment status changes in some way.
This is very, very direct. It's targeting those classic severance packages you get on termination. But it also goes a step further. It covers any payment made to modify the terms of employment. So, for example, if an employee gets compensated for, say, a demotion or a significant change in their role, that payment is now explicitly taxable as a profit in lieu of salary.
Okay, now here's where Section 18 gets really expansive. Clause B deals with payments made outside the formal dates of employment, and this is a really critical extension of the law.
This is how the scope of Section 18 just gets so much wider. It yanks joining bonuses, the ones paid before day 1 on the job, directly into the salary's tax net. And maybe even more importantly, it covers payments after the job ends, like those non-compete fees. The message from the law is pretty clear. Even if the formal relationship is over, if the payment is a direct result of that relationship, it's still taxed as salary. Simple as that.
Okay, that's enough of the theory. Let's take a look at how all of this comes together in a practical, real-world scenario. Let's check out this case study. So we have Mr. Sharma. He leaves his old job and gets a severance package of 5 lakh rupees. That falls squarely under Clause A. Then he gets a 2 lakh rupee joining bonus from his new employer, which, you guessed it, is covered by Clause B. Under this new law, both of these amounts, totaling 7 lakhs, are classified as profits in lieu of salary and are fully taxable under the head salaries. No more ambiguity.
All right, so we understand the law now, but how do we make sure that we and our clients actually follow it correctly and avoid making any of those costly mistakes?
The advice we give our clients really needs to be a clear three-step process. First, classify every non-routine payment to see if it's linked to termination, joining, or modification. Second, make sure it's reported under the right head, salaries. And third, and this one is absolutely non-negotiable, advise clients to keep meticulous documentation. Contracts, letters, payment advice. These are your evidence if the nature of that payment is ever questioned.
And these are the common traps you really need to help your clients avoid. The biggest mistake is still treating these payments as capital receipts. Section 18 makes it absolutely clear they are not. Another pitfall is forgetting that payments from a prospective employer are also taxable. And remember to add up all such payments and know that whether it's a lump sum or paid in installments, the tax treatment under Section 18 is exactly the same. All right, let's wrap this all up by summarizing the key points that you really need to remember about Section 18. So, what's the bottom line here? Section 18 of the Income Tax Act 2025 is really a powerful consolidation tool. It moves beyond just job titles and employment dates to look at the real substance of a payment. If a payment comes from an employment connection, past, present, or future, it is now firmly and clearly taxed as part of salaries. That gray area is pretty much gone. And that covers our deep dive into Section 18. I really hope you found this explainer useful. Thank you so much for watching. Please do like, subscribe, and share this with your colleagues. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.